Pivot points are a technical analysis tool used in stock trading to identify potential levels of support and resistance for a given stock. Pivot points are calculated based on the previous day's high, low, and closing prices. Here are the steps to use pivot points in stock trading. Calculate pivot points. To calculate pivot points, you need to take the high, low, and closing prices of the previous day. You can use the following formula to calculate the pivot point. Pivot point equals high plus low plus close, 3. Once you have calculated the pivot point, you can calculate the support and resistance levels. Determine support and resistance levels. There are several levels of support and resistance that can be calculated using the pivot point. The most commonly used levels are R1, R2, R3, S1, S2, and S3. These levels are calculated based on the pivot point and the high and low of the previous day. For example, R1 equals 2x pivot point, low of previous day, S1 equals 2x pivot point, high of previous day, R2 equals pivot point plus, previous day's high, previous day's low, and so on. Use pivot points to make trading decisions. Once you have calculated the pivot point and support and resistance levels, you can use them to make trading decisions. If the stock price is trading above the pivot point, it is considered to be in a bullish trend and traders may look for buying opportunities. Conversely, if the stock price is trading below the pivot point, it is considered to be in a bearish trend and traders may look for selling opportunities. Traders may also look for potential reversal points when the stock price approaches a support or resistance level. Pivot points are levels on a chart that are calculated based on the previous day's high, low, and closing prices. These levels are considered potential areas of support and resistance for the price of an asset. A pivot point strategy typically involves buying or selling an asset when it reaches certain levels based on the pivot points. There are several different pivot point strategies that traders can use, but some of the most common ones are: pivot point breakout strategy. This strategy involves buying or selling an asset when it breaks through a pivot point level. Traders may wait for the price to break above a resistance level, R1, R2, or R3, or below a support level, S1, S2, or S3, before making a trade. Pivot point bounce strategy. This strategy involves buying or selling an asset when it bounces off a pivot point level. Traders may wait for the price to touch a support level and then bounce higher, or touch a resistance level and then bounce lower, before making a trade. Pivot point reversal strategy. This strategy involves buying or selling an asset when the price reaches a pivot point level and then reverses direction. Traders may look for price action signals, such as a doji candlestick pattern or a bullish or bearish engulfing pattern, to confirm the reversal before making a trade. It's important to note that pivot points are just one of many technical indicators that traders can use to make trading decisions. Pivot point strategies should be used in conjunction with other technical and fundamental analysis tools to make informed trading decisions. Traders should also use risk management strategies, such as setting stop-loss orders and position sizing, to protect themselves from potential losses. Pivot points should not be relied on solely to make trading decisions, but rather used in conjunction with other technical and fundamental analysis tools to make informed trading decisions.